a wee story. My late stepfather died, and we found an insurance policy that he'd had when he got married, which was over 50 years before. And there wasn't much to it. Is that the sort of thing that does happen?
Yeah, it does. The policies have changed over the years, so some of those old policies had a value at the end of them over a certain period of time, and for those they've basically after a long period of time convert more into an investment type policy because there's a value at the end of it. That's changed over the years, and now we have life insurance, which is really what we call term life insurance. So it is basically paid out on death, basically. Yep. Funny thing, we call it life insurance. In fact, it's actually death insurance. So some of those policies that have been sitting in the cupboards for 50 years or whatever are probably at some stage reasonably valuable and probably shouldn't be touched. But one of the things we need to understand about insurances is the need, where there's a need. Life insurance itself is a very simple product. Someone dies and someone gets paid. It's really easy product. What's difficult about it is who gets paid, when, and how much. And that changes throughout our lives. The need and our circumstances and our positions within life changes. For life insurance to be a necessity, essentially we need what we call the 2 Ds, which is debt and dependence, or dependence and or. If you have both, there is a real definite need for life insurances because your death has an impact on dependents and the debt that's left for those dependents. So there is a real need. As we get older, that need changes. Our dependents grow up, leave home. Believe it or not, they do.
Never leave your wallet, but they do leave home.
That's exactly right. But so does our debt change. You know, we take a mortgage out when we're younger for our home and we pay that off over a period of time, and our circumstances change. So as our dependents and as our debts change, so should our insurances, our life insurance. If we don't have any debt, don't have any dependents, we probably don't need any life insurance or very little. But we may need other insurance because we don't have people to look after us if we're ill or infirmed.
So Barbara Lee, that opens another door, doesn't it? That's the terminal illness one that you guys talk of?
Yes, that's right. And that's the thing. I mean, products are being developed all the time, new products, and the products ranges are improving to the policy wordings, and it's really important that you have the most up-to-date policy wording, so that your outcome at claim time is going to be most successful.
So that means the endowment policy that you were sold when you were first married or 50 years ago is probably not really worth the paper it's written on.
Well, that has to be analysed properly. But, the new types of covers coming through, as you say, the need for life insurance becomes less over time, and it becomes more about what do I need for myself rather than, leaving money behind. So this new terminal illness cover, for example, that pays out for you as a person if you're diagnosed with a terminal illness and likely only have 12 months to live. And it's a bucket of money for you to go and do the things that you've always wanted to do while you can. And it's about a third of the price of life covers. So, to have access to these types of covers, this is where it's great to get together and just to go over what you've got, and we can recommend these types of covers depending on your circumstances.
So Hank, you're looking at a farmer who doesn't have any debt or dependence because he's passed the farm on. But a terminal cover will mean that if he gets terminal illness, that pressure doesn't come onto the farm income.
Correct. So it's and again it depends on a lot of external circumstances surrounding that. Does he have somebody to look after him? Is his wife still there? Is she able to do that or help with that? There's a whole raft of...
Or the other way around,
the other way around, as the case may be. Yeah, absolutely. So it depends on a whole lot of ancillary situations that encompass a particular person to see what sort of insurances they need. You need to understand that insurance itself is just a funding mechanism for what you want to happen in a certain event. In some cases, it's been described as pre-arranged funding. If you need money, where do you go? The bank. The bank will only lend you if it's a good risk.
Yeah,
and it's not a good risk when things are going wrong. So what insurance is, it's a pre-arranged funding in the event that something goes wrong. The amount of funding is dependent upon the circumstances and what the client wants to happen if things go wrong.
And the trouble is, if something does go wrong, that's when income sort of, can stop or be severely reduced, and your expenses go up, because you've got all these medical expenses, to get a taxi to the hospital or whatever's required. So it becomes this huge imbalance, and it becomes very difficult. So with us putting funding there, that's the whole idea, is to take away all of that financial pressure so that you can cope with what you're, having to cope with.
Barbara, who do you want sitting around the table when you discuss things like terminal cover?
Oh, the
whole family.
Well, yes, that's right. The whole family. We look at children. These things happen, unfortunately, every day. And what we're wanting people to do is just put a plan in place. We don't want them to ever have to use it, but if they do have to use it, then we've got a good plan there for them.
Because it's all about farm succession, isn't it?
Yeah, it is, and that depends entirely upon what succession plan you want to happen, and the cost that's around that, and the timing around that. So what happens today may be quite different from what may happen in 5 years' time, or even in 2 years' time. There might be completely different circumstances, and that's why insurances need to be regularly reviewed. I should say there should also be a balance between need and affordability. Mm-hmm. We can give as much insurance as you like, but there's no point in doing that if it's not affordable, if it doesn't come within budget. So there has to be a balance between need and affordability.
Is there a rule of thumb that you can sort of say, advertising, they say between 5 and 10% of turnover. Is there a sort of a rule of thumb, or is it totally page by page?
Yeah, no, I don't think you can put a rule of thumb on it. It's dangerous to do that, because then you give clients a false impression of where they're at. We help them identify circumstances that they're in, and then help them identify on what they want to happen should a certain event take place.
Best time to buy is like a tree. You either plant a tree 20 years ago or today.
Well, yeah, that's, when it's a chicken and egg thing. When we know that when we're younger, we're more likely to be injured or infirmed as a result of an accident. But when we get to our age, it's that does a complete flip, and we're more likely to be affected through an illness or an ailment, or our body's wearing out.
Yep.
So there's a change in circumstances, a change.
Hence the reviews.
Yeah, absolutely.
Yes.
Thank you both very much indeed. Listen, if you'd like to recap on what they've just been saying, or anything else that's been on the program this week, check our website. It's ontheland.co.nz. I'm Rob Cope Williams. You've either been watching or you've just missed the program.